Last week I got a question from John in Queensland. It was a good question and I thought perhaps other people might have the same question. His question was, is investing in shares gambling? Is investing in shares gambling? It's a fair question. And I think for some people, the answer is an emphatic yes. I think everyone's got an uncle or a cousin or a sibling or a friend who's forever out there on the local chat forums looking for the next great idea or listening into conversations on public transport hoping to get the next great tip. And for those people, I think genuinely it is a case of gambling rather than investing. And that's okay. But I think you need to be honest with yourself as an investor or a punter if you're looking to invest or if you're looking to punt. Now, to my mind, there are probably two key ingredients to ensure that you're investing rather than punting. The first of the key ingredients is that you need to have a genuine, deep understanding of what you're investing in. And the deeper your understanding of that investment, the better your chances are of success. Now, internally, what we try to do to challenge and scrutinize our ideas is we challenge each other. If Vass has an idea, he'll bring it to me and I'll try and be the devil's advocate to unwind what the holes might be in his studies or in his research. And vice versa, if I have an idea, I'll challenge it and scrutinize it against Vass. More than that, once we've done the internal assessment, we'll often go and try and find someone outside of our fund, someone who is an expert in the field, and again, scrutinize that idea once again from an outside expert source. And what this forces us to do is to have a higher degree of conviction in this idea. And often it means that once we're asking questions, we've got to go back to source to make sure that we genuinely do have an answer to all of these challenges. And that leads to much better outcomes for the investment and for our fund. When we think about investing, we think about investing on a 3 to 5 year time horizon. In our experience, 3 years is about how long it takes. Sometimes it takes longer, but it's about how long it takes for an unloved company to be appreciated by the broader world and so reflected in the share price of that company. And the truth is that if you don't have at least 3 years to invest, you're probably best off seeking financial advice to work out if you might be better placed putting your capital in a high interest account or in an offset mortgage account. But really 5 years plus, is the ideal period to invest in. Investing for 5 years means that you have an opportunity to see the natural cycles of the market play out. You know, we've often had clients ask us, is it worth investing with you guys for 6 months, 12 months, or 24 months? And our response has always been, you don't want to be risking capital that you need in the near term in pursuit of returns that might take a longer time to eventuate. The worst thing you can imagine is putting that money to work only to see the market correct and your shares fall with the broader market. And so by giving yourself a 5 year period, you give yourself the chance to recover from that broader market cycle and you give your investments the best chance of success. All right, so let's bring this to life with a recent example within our fund. About 4 years ago, we entered into an investment with a company called Van Gogh Metals, which later became Catalyst Metals. We essentially gave them $9 million via a convertible note. A convertible note is essentially a loan where we have the option to convert that loan into equity at a predetermined price if we choose before the maturity of that loan. Now, over the period, we received back our $9 million invested. We also received 3 million shares in Catalyst. And more recently, after the resolution of a disagreement between us and the company as to some of our conversion rights, we settled for an additional 2.5 million shares. What does that all mean? Against a $9 million initial investment, if you account for the cash and account for the current market value of the shares that we received, the value of that investment went up to $43 million. Now that sort of outcome is a little bit outside of the square, and it certainly required some activism from us, both in the initiating of the investment and also in pursuing our fullest rights. But it is in line with our philosophy, investing in good quality companies with significant upside and limited downside exposure. Fundamentally, our investment in Catalyst worked out for three key reasons. Number one, we understood the risks and the benefits of what we were investing in and how we invested in it. Number two, we were prepared to put in the effort to get the best possible outcome. And number three, we were prepared to take the time, as long as it took, to see the full fruition of our original investment. So how do you avoid gambling when you're trying to invest? There's two things. You've got to put in the effort to achieve the insight, to understand what you're investing in. And you've got to give it time. Thanks, John, for an excellent question.